This discussion is by two leaders in the insurance and finance sector. Jay Bruns is our host, and Jay was the Chief Sustainability Officer at the Hartford. He was there for 12 years, has deep experience in insurance and finance, and he's now the Climate Change Advisor to the Washington State Insurance Commissioner. So advising the Insurance Commissioner on all things climate, and Mike Kreidler has been a real leader as an insurance commissioner in Washington, requiring the insurance industry to get ahead of climate risks. And he'll have Chris Bell, who's now with Guardian Life, long finance experience as well. So I'm really looking forward to having them. Please join me in welcoming them to the stage. Thank you.
Amy. Well, thank you all for being here. We're very excited to be here, and I hope that in the next half hour that Chris and I will be able to leave you with a better understanding about how the insurance industry is working and maybe not working on climate change, and also the role that insurance regulators play. I want to also very much thank the Sun Valley Forum and our host Amy for welcoming us back again this year. My boss Mike Kreidler sends his greetings. We have a great and collaborative relationship with Amy that we're just delighted to continue with. And I was thinking about her this morning when at breakfast I heard the ubiquitous question at this forum, and that is, well, how did you get to know Amy? And I'm thinking that question has probably been asked by at least 1,000 different people. I mean, as you all know, she's quite a connector, and I think we all benefit from that. I want to pivot. This morning we heard from, I think, 8 different companies, and almost all 8 of them have been founded in the last decade, or more recently. We're going to now talk about an industry that started almost 500 years ago, the insurance industry. It started with Lloyd's of London. These were ship owners in London who, back then, it was pretty dangerous to send a ship to the New World and back, and these ships went down regularly. And a number of ship owners got together around the table and decided, well, in order for us to mitigate our risk, to manage our risk, maybe it's best that we all pool the risk. And so if a ship goes down, not just that ship owner, but everybody pays a portion of that. And that's the basis for modern insurance. Before we get into insurance and climate change, and before I turn the mic over to Chris, I wanted to give a little bit of a level set about insurance. It's a risk transfer mechanism. You all know, if you have insurance, I think everybody in the room will, that you write a contract with your insurance company, and that spells out what the insurance company is going to cover and what it's not going to cover. Insurers have, for these past almost 500 years, been, I would argue, pretty good managers of risk. They know how much risk that they are taking on generally. They know how to price for that risk. It's a private sector effort, and they're pretty, I would say, well regulated by the state-based insurance regulators across this country. When you look at the size of the insurance market, the U.S. insurance activity comprises about 3% of our GDP in the United States. And if you think that, I think last year our total GDP in the U.S. was 21 trillion, so it's a very large industry. That industry is spread across 6,000 different companies that operate in the United States. So it's a very diffuse industry as well. And those 6,000 companies, if you add up all of the investments that they have, it's $9 trillion. Now we're going to talk about insurance investments a little later, so I thought I wanted to make the point about how insurance investments are different. We heard from the banking industry yesterday and how banks make decisions on investments. Insurance companies, what they're doing is they're collecting premium that you and I send to them every month, and they know some of us are going to have an accident or need a payout. But in the meantime, they want to make some money on that, on those investments. So they take the money in and invest it generally in fixed income investments. I think I'm right when I say that if you look at the total $9 trillion worth of investments across the country, the largest single share is in U.S. Treasuries because it's a safe investment. They invest in all sorts of other government bonds as well as corporate bonds and lots of other instruments that give them a fixed return, but they really don't invest very much in the stock market, say. So they're different from banks and private equity firms and others, foundations and others who invest their money. Not much goes into the stock market. With regard to what an insurance commissioner does, each of the 50 plus insurance commissioners across the country, we really have 50 states, plus there's a commissioner from the District of Columbia, and then there are commissioners from the U.S. territories as well, and Puerto Rico. So if you add it all up, I think there are 57 different insurance commissioners across the country. Their job is to protect the citizens of their state or territory and to ensure that insurance companies are following the laws and encouraging them to make sure that they are treating their customers fairly. The other big thing that insurance regulators think about a lot is to ensure that the companies remain solvent, that they are prudent in their investments and their underwriting, because if those insurance companies go under, then the citizens of the state are not well protected, obviously. So they care a lot about solvency as well. On climate, insurers, especially at the National Association of Insurance Commissioners, this is this group in the US nationally, have really made some big steps on requiring companies to be good with with transparency and encouraging them to do what they can to help us all get to net zero. I'm going to stop there and turn it over to Chris Fowle, who, as you know, is head of ESG integration for investments at Guardian Life. But importantly for me, he just comes from very recently from the Principles for Responsible Investment, and before then he was at CDP. So I know he's going to be speaking personally, not for Guardian Life, but he brings a lot of background to this that I think will help us with this discussion.
Thank you,
Thanks,
Jay.
guys.
And it's fantastic to be here, my first time in Sun Valley, and I've really enjoyed meeting many of you and engaging in fantastic conversations and learning a lot in the process. And it's true, what Jay says in terms of where I'm coming from. First of all, I work at Guardian Life, but it's a very new role for me. I've been there for less than 2 months. And so, in fact, my comments today are my own personal comments and not related to Guardian Life's strategy with regard to ESG, although my new role is to help think about ESG strategy for investments specifically at Guardian Life going forward. And so I'm going to talk a little bit about my prior role. I was with an organization called the Principles for Responsible Investment for more than 5 years as the director for the Americas, helping manage signatory relationships across North and South America. And this organization has helped many types of investors, including insurance companies, think about how to integrate ESG into their investment processes. And in fact, there are almost now 5,000 members of the PRI around the world. The signatory members of the PRI make a commitment to a set of 6 principles, which in total allow them to at a high level, understand, benchmark their current process against well-regarded, road-tested set of principles, ideas, processes that they can use to start thinking about responsible investment and how it applies to their context. to their organization, how they invest, meaning if they're directly investing in the markets, buying the stocks or bonds or other types of financial assets themselves directly, or doing it through third-party managers that they might hire to do it on their behalf. The organization, PRI, was actually founded by the United Nations more than 15 years ago. It's now a standalone independent nonprofit headquartered in London, but retains the two affiliations with the UN, both with UNEP-FI, the United Nations Environmental Program for Financial Institutions, as well as the UN Global Compact. And the total assets under management are more than $121 trillion at this point. So let's talk a little bit about what we mean by responsible investment. And here I'm showing you a definition that the PRI presents as what it means. And essentially, you can boil it down to thinking about a strategy and a process for incorporating ESG, environmental, social, and governance issues, into an investment process and thinking about active ownership. And so that's a pretty general definition that's relatively high level, and there's a reason for that. It's that there are, as I'd said earlier, many different types of investors that are part of the PRI and that look to the PRI for guidance even if they're not signatory members. So ESG integration is a relatively broad set of practices that investors can pick and choose from to fit their organizational context, the resources they have, and as I said earlier, how they invest, whether it's directly or indirectly. And what are some of the factors or ESG issues that one might consider should be incorporated into an investment process? Many investors will tell you that, for example, if they're a fixed income focused investor, they're looking at the credit quality of an issuer, a company that's issuing a bond, for example, and that they're already taking into account the most material financial risks that could affect the ability of that issuer to repay their obligations, their bonds, at maturity. What I have on the slide here is an example of some of the risks identified by participants in a World Economic Forum annual survey. This one is a little dated. It's from 2019, so pre-pandemic. Certainly, pandemics would be at the top of the list if this had been done in 2020 and on. But I think the example still very much holds in that many of the top risks seen by the survey participants here can be related to ESG issues. The challenge, of course, is that many of those issues are perhaps newer in the investment context, and there isn't as much context, information, data, examples to learn from, and so it's challenging for investors, even if they're very good credit investors, in understanding the ability of a company to repay debt, still very challenging. And so that's why organizations like the one that I'm working with now are looking to bring in external knowledge and resources to help them understand these issues and comply now with certain responsibilities they have. They're feeling the sort of the pressure, if you will, from many different perspectives. There's the data, the factors, the materiality, we call it, of the risk factors that they're thinking about. There's the market demand coming from their clients. So in the case of an insurance company, it could be policyholders. If you're a pension, it could be the beneficiaries of a pension, et cetera. And they're thinking about regulation, and we'll talk a little bit more about that in a moment. And all of this is underlain, as you can see on the slide, by better and better analysis, information from academics, also from the so-called sell side of Wall Street, those analysts and researchers that are creating tradable ideas for the buy side, the folks like an insurance company that are buying the assets that the banks and other sell side folks are selling. There's a lot more information and analysis sort of proving the case that ESG does make a difference when you're thinking about about this work. And so I want to stop and maybe with Jay, talk a little bit about the regulatory tailwinds that we're seeing, whether it's from the New York State Department of Financial Services, which is our primary regulator. We're regulated at the state level, as Jay had mentioned, the NAIC that Jay mentioned, the Securities and Exchange Commission, which has been mentioned a few times today, and then a robust set of what I characterize here as international norms. And there's a bit of an alphabet soup there at the bottom. Some of them you might have heard of, the TCFD, the Task Force on Climate-Related Financial Disclosure. CDP, where I used to work, the former Carbon Disclosure Project, a global organization working on environmental disclosure and collecting that on behalf of investors and feeding it back to investors as inputs into their investment processes. The PRI, where I also worked, and I described already, and then the PSI, which is actually relevant to the other side of the balance sheet of an insurance company, the so-called underwriting side, the principles of sustainable insurance, which is working much like PRI is on the investment side of the equation. So Jay, did we want to talk a little bit more about the regulatory aspects then?
Yes, especially from now sitting in my role as a regulator. I wanted to focus a little bit on the NAIC as well as talk about the SEC effort. We've heard about the SEC effort a little bit. Securities and Exchange Commission is working to require all publicly traded companies in the United States to take the data that they have on climate change and put it in their financial information using the template set out by this TCFD, the Task Force for Climate-Related Financial Disclosure. And if they are successful with the timeline that they're on now, that won't be a requirement probably in 2 years or so. Separately, the National Association of Insurance Commissioners under my boss, Mike Kreidler, in 2009 began to require all large insurers in the United States to report annually on how climate change affects their business. Basically, it was an 8-question survey. The questions came right out of CDP. The answers are public. They are required annually. They go on the California website of the Department of Insurance. You can look there and see how your insurer answered that questionnaire in 2009, 2015, last year. The NAIC, at a meeting that I attended just last month in Kansas City, decided that after we've been working on this for 2 years, but as of the end of this year, all of those companies that report that are required to report will be reporting under the TCFD guidelines. So that means really the SEC effort is important for the rest of the economy and all that, but we've actually preempted in a way, the state regulators have preempted in the insurance industry. They are already by this end of this year going to be required to report. And we capture through this about 80% of the written premium in the United States. That's because we capture the very largest companies. We don't require smaller insurance companies to do it. The SEC rules, when they come into effect, they only capture publicly traded insurance companies, not insurance companies by size. So they would, when they do bring in their rules, that would only capture only about 35% of written premium in the United States. So I just wanted to point out that in the insurance industry, I think our regulators have moved more quickly. And as far as I know, there is no other industry worldwide that where their regulator has been requiring them to report solely on climate change and its effect on their business outside of the U.S. insurance industry. So,
no, it is a very big development for the United States regulators, and at the state level in particular. New York has been at the forefront, I would say,
yes,
in terms of defining some of the requirements and what they're really looking for their insurers to report back to them on. And the New York State Department of Financial Services will actually be using the NAIC's climate survey mechanism to ascertain exactly where the insurers doing business in New York are. So all of these efforts are connected, and to a certain degree, I would say, informed by what's been happening globally in the insurance sector. Would you say that's fair?
Yes, I think that is fair. I will say, we're very involved with what's happening globally. My boss was also a founder of something called the Sustainable Insurance Forum, which is insurance regulators around the world who care about climate change. And now the U.S. Department of Treasury, NAIC, and many other countries have joined it. It went from, I think, 8 when he was there to when he started it, to help start it with the California Insurance Commissioner, to 35 members today. So that's the transparency and disclosure is very important, but I think we should talk a little bit more about what else insurance companies can do. I was just asked about, well, why don't insurers do more on mitigation? And let's look at the risks that they face. You know, they have to manage all kinds of risks. The risk of you all having an auto accident, pandemics, cybersecurity. They're looking, insurance is a big data industry. They collect massive amounts of data in order to price their products and in order for the insurance company to decide whether they want to be in that market. So one question is, why aren't insurers more involved in paying for the mitigation of risks? And that's a very good question, and it is a private sector industry, and so that is regulated. So, you know, one question is, I see some level of mitigation. For example, in some markets, insurers will give discounts to people, just like a good driving discount. They'll give a discount if you take precautions in your house to use tie downs where there's wind, so that the likelihood of your roof blowing off in the next big windstorm or hurricane is lower. For communities that use FireWise principles, which means, you know, you don't put your firewood next to your house, and you make sure you clean out your gutters from pine needles and things like that. Some insurers have decided that if the insured uses FireWise principles, they may give them a break on that. So there are, at the margins, I would say, insurance companies do care about mitigation. But insurers, you know, the other thing about insurers is they, as I said, I think they manage their risk very well. Sometimes the way insurance companies manage risk is not necessarily in the best public interest, and my boss is very keen to make sure that these markets work well, because in some places, right now, California, a lot of insurers have decided that the fire risk in many locations is too high, and so they're pulling back from the market, or they are raising the prices of insurance just so quickly because they see all of a sudden, to cover the risk that they now feel that they face, they need to charge more. In most places, those rates that they are charging have to be approved by the insurance department. But you can quickly get out of balance if the insurers aren't managing, collectively aren't managing the risks that they face in a certain market, and regulators are very tough on making sure that insurers, they're allowed to leave the market, but they have to do so under certain circumstances to prove that they have to do it. So.
Mm-hmm. Now, that's really interesting, and those are great examples on sort of the physical risk, the mitigation side of, say, for a property and casualty insurance company, and on the life side, I'm at a life insurance company. There's a lot of interest at Guardian specifically, but more broadly within the life industry, to look at well-being broadly in terms of you know, what are the health implications of the insured, and how that can be improved through some of the you know, related incentives that the insurer might provide, and I think that does extend actually to the investment side of the balance sheet as well. In that, and we've heard a lot about the SDGs, the Sustainable Development Goals. We've heard about impact investing, et cetera. But I think even in, call it the more mainstream and I'll dare to say more conservative investment space, and insurers are fair to say more conservative investors, there's more of a interest and an impetus to explore the outcomes of their investments, not just in an impact portfolio, which might be created specifically for specific impact goals, but more broadly in the portfolio. And I think that trend will continue as the data continues to improve and we're able to actually measure, communicate, be more transparent about the intentionality behind some of the investments and the outcomes or impacts associated as relates to the environment and society.
Well, we have about 30 seconds. I had one other point that Chris and I have talked with beginning our dialogue a couple of months ago, and that is we talked about how can insurers use these investments that they make. Insurers buy a ton of utility bonds. Mostly 5% of the overall overall investments or utilities. Doesn't sound very much, but I talked to one insurer once who they did an analysis of their investments, and they thought that represented about 65% of their greenhouse gas emissions holding in their investments. So we're thinking about why don't insurers have a dialogue with the utility industry to say, look, we buy a lot of your bonds, that's fine, but we want you to move more quickly to renewable. And as it turns out, Chris has uncovered that that happens already in Asia, so we want to bring it to the United States. Well, thank you everyone for listening to us. Chris, any last word?
No, I think this is fantastic. Really happy to share some of the learnings that I've made over the last 8+ years on my journey, and look forward to communicating with you in future about the actual practical work I'll be doing with Guardian going forward.
Thank you very much. Okay, this way.